This is Horizon's Middle East and Africa. Our top stories this morning. A growing rift despite the hugs and handshakes between Trump and Macron. A split is evident as Washington breaks with European allies on Russia and Ukraine. Plus, the EU agrees to partially suspend several sanctions on Syria's energy industry and some banks. Chinese stocks whipsaw after Bloomberg learns the US is sketching out tougher versions of its curbs on China's chip industry. It's just gone 8 a.m. Tuesday morning across the Emirates. It's 3 p.m. Tuesday afternoon here in Sydney. I'm Paul Allen in for Jemana Beseche. Let's take a look at how markets are tracking. We are setting up for a positive start for US markets. We got S&P futures better by about 1/5% right now. We're seeing yields continue to ease as well. We have seen yields climbing following the election in the US back in November, but now they're back to pretty much where they were. We've got a number of Fed speakers coming up in the coming hours as well. We'll be hearing from Laurie Logan, Thomas Barkin and Michael Barr as well. Taking a look at the oil price, we're going to get to that in a minute. 75.16 for a barrel of crude. A little bit of disagreement over where prices might be heading. Bank of America sees OPEC Plus restoring about 150,000 barrels a day in April. RBC, meanwhile, disagrees with that, but as I mentioned, we'll have a conversation shortly about the EU partially lifting its sanctions on Syrian oil. Bitcoin's an interesting one too, continuing to slip. It's doing better than some of the altcoins though. Ether, Solana, Doge, all down more than 10%. We did have strategy buying about $2 billion worth of Bitcoin over the past 7 days, but that's not really supporting a market that's been struggling for conviction even as other assets rise. Well, the big one coming up though, Nvidia earnings. Let's take a look at how hedge funds are treating this stock. They are reducing risk in big tech ahead of those earnings. They're due after the close in the US tomorrow. So this is the second straight week that we've seen hedge funds trimming their exposure to the Magnificent Seven stocks, now at their lowest level since April 2023, according to brokerage data from Goldman Sachs. All right, let's take a look on how markets in Asia are faring. It's been quite a dramatic day. Avril Hong's in Singapore. Avril, what are you watching?
Yeah, a lot of drama, red on the screen, steep declines on the region's benchmark, but they've paired a large part of the earlier declines, and it's all centered around Chinese tech. I mean, they faced a key test in the form of Alibaba ADR's almost 11% decline overnight, Trump's salvo against China, and then we're since hearing this morning about how they might be tightening these restrictions even further surrounding chips. But it looks like investors are able at this point to just look past all of that. We saw the Hang Seng Tech decline about 4.5% earlier in the day. Look at where it's seated now, and a lot of this has got to do with mainland investors buying the dip in Hong Kong stocks. So the southbound flows, if the buying continues at these rates, we could see them at multi-year highs. Really interesting to see today. Now, aside from what's happening in Chinese stocks, also highlighting Japan, we're back from a long weekend. We saw those export-related names decline amid concerns about U.S. growth, but the trading houses, those are doing well today amid the Warren Buffett potentially boosting their stake in some of these names, including Marubeni. Paul.
All right, Avril Hong in Singapore, thank you. Well, US President Donald Trump is deepening Washington's split with its traditional allies as he drives for an end to the war in Ukraine. The US withdrew its previous stance condemning Russia's invasion of Ukraine at the United Nations. And that's a stark policy reversal from President Biden's administration and another blow to ties with the EU. Now, this comes as French President Emmanuel Macron visited Trump in Washington in an effort to get Europe back to the table in talks with Russia. Joining us now is Henry Meyer, Bloomberg's senior reporter. So, Henry, all of this does seem a little bit surreal. Can you walk us through what happened?
Yes, I mean, you do have to pinch yourself when you see the US and Russia voting together at the UN against, resolution backed by the US's European allies. I mean, if you fast forward to a week ago, US and Russia senior officials meeting in Riyadh, Saudi Arabia, to talk about how to end the war in Ukraine, with no participation from Ukraine, no participation from European countries. what you have here is a track with Russia that Trump has launched since he became president. His goal is to try and end the war in Ukraine as swiftly as possible. And one of the policies which he's adopted is to refrain from any criticism of the Russian invasion. Let's be clear about it. They invaded Ukraine 3 years ago, a completely unprovoked attack on their neighbor. The US now is no longer characterizing this conflict as a result of a Russian invasion. And the goal is to try and move towards, as swiftly as possible, to a solution of this war.
Yeah, so what's President Trump's strategy here? Has he gone over to Putin's side, or is that pushing things too far?
I mean, yes and no. Clearly, President Trump's view of this war in Ukraine is that the former administration, his Democratic predecessor, Joe Biden, they completely mishandled it. They allowed the war to drag on for 3 years to essentially where we are today, which is a standstill. There's some Russian progress on the battlefield, but essentially, the war is not moving forward. Hundreds of billions of dollars spent in aid from the U.S., from Europe, hundreds of thousands of people killed. He believes that he needs to work with Putin to end the war. At the same time, it's a little simplistic to suggest that Trump completely shares Putin's vision. Putin's vision is to control Ukraine, not just the 20% of the Ukrainian territory that he holds at the moment, but he wants to, take over the whole country, maybe not actually having Russia control the country as such, but, be in a position to influence what's going on there. Trump, from what we hear, is that he's determined to keep Ukraine as an independent sovereign state. He supports the presence of European peacekeepers after the war ends. So I think that he's not completely aligned with Putin.
All right, Henry Meyer, Bloomberg's senior reporter, thank you. Well, the European Union has agreed to partially suspend several sanctions on Syria's energy industry, including scrapping bans on importing crude from the country and on exporting technologies to the oil and gas industry. The bloc says the move aims to facilitate engagement with Syria in areas of energy, transport and reconstruction, and to allow for associated financial and banking transactions. Well, joining me now is Paul Wallace, who leads our Middle East, North Africa economy and government coverage. So, Paul, is this going to be enough to help aid Syria's recovery?
Hi, Paul. It's certainly a step in the right direction as far as Syria's new government is concerned and its new president, Ahmed al-Shara. This is the type of thing they've been really pushing for and that they put as a priority to bolster the war-ravaged economy in Syria, and that's to get sanctions removed, especially those by historically key Western partners. In some senses, this is sort of baby steps, and it's not going to lead to any kind of overnight significant transition. But it certainly shows that the EU, which has been trying to engage with HTS, the rebel group that was mostly responsible for toppling the Assad regime late last year, has been trying to engage with it and try to ensure that it commits to an inclusive government, and that that would lead to something like we saw yesterday, the agreement to ease some sanctions.
Well, meanwhile, Israel says it's carried out what it called targeted raids in the Syrian buffer zone. What do we know about that?
Well, I think this is something that's going to become more and more of an issue. Shortly after Bashar al-Assad was toppled, Israel moved troops beyond a demilitarized buffer zone on the Syria-Israel border into Syria proper. Only slightly, but still, that was a pretty significant move. It said it would keep them there as a defensive measure. The bigger picture here is that Israel is very, very wary of the new government in Syria, given its Islamist roots. And Prime Minister Benjamin Netanyahu's call for southern Syria to be demilitarized, that call in recent days, is not something that has gone down well in Syria. There were reports of some protests in Aleppo because of it. And I think what we are seeing here is a slow build-up of tension between Syria and Israel, and it's going to be something to watch over the coming weeks and months.
All right, Paul Wallace, who leads our Middle East, North Africa economy and government coverage. Thanks for joining us. Asian stocks fell initially after President Donald Trump's move to curb Chinese investments and proceed with tariffs on Canada and Mexico, prompting investors to trim risky bets. Joining us now is Rashmi Garg, a senior portfolio manager at Abu Dhabi Capital. So, Rashmi, we just saw on the screen there a little bit of a retracement for Chinese equities, and we've also got the US now considering more restrictions on China chip production. So when you see pullbacks like this, what do? Do you sit back in the anticipation that there could be further selling, or do you buy these dips?
So I think it really depends upon the situation. And I think in the current situation, I would say that I would recommend buying the dip. And the reason for that is that, there has been some reason why the Chinese stock market rallied so much, especially the tech stocks year to date. And the reason for that was, of course, DeepSeek as we saw it. It was a cheaper large language model, an alternative to the expensive, models that were there in US. And then also it showed the ability of Chinese, technology companies to be able to innovate and to be able to do something within limited resources. So I think that is something which says a lot about innovation going on in China. So that is a couple of things. And then apart from that, the valuations of the Chinese market were very attractive, towards the end of last year. China has been a market which has been shunned by international investors for a fairly long time for a lot of reasons. And we've also seen some narrative change on China. The latest meeting that we saw, Xi shaking hands with Alibaba's Ma and, getting rich first, a phrase that was introduced. I think that to us is an indicator of a change in stance from the Chinese premier towards, private companies. And that was a major deterrent in the past, the sort of the line that the Chinese premier had adopted towards private companies, towards investments. So I think that all these things make us more positive on China as of now.
Yeah, and you mentioned the MPC. The next MPC is coming up. Do you anticipate any announcements around support for China's economy, China's markets as well, in this environment of trade risk?
Yes, we would expect so. We would expect that there should be some supportive measures announced, especially, given that this whole tariff thing is escalating. We've recently seen the salvo of announcements that have come out from the US, Trump's intention to go forward with the tariffs on Mexico and Canada, on Chinese ships, the fees that were imposed. All of these things clearly show that Trump is taking a hard line on tariffs. And as a result, the countries will need to retaliate, especially China in this case, to support their domestic companies. And therefore, we do expect some sort of fiscal broadening from China.
Rashmi, where do you put capital at work at the moment? What are your favorite opportunities right now?
So I think, given the pullback today in China, if you're talking about immediate, I would say that China presents an attractive opportunity. We continue to like gold a lot as well. And the reason for that is that, we are in an increasingly uncertain geopolitical environment. And gold really acts as a hedge against any volatility in this sort of an environment. So we like gold. We also like the European stock market, but heavier stock pickers, because the discount that Europe was trading at towards the end of last year, that has narrowed significantly. So it cannot be a blanket trade right now. Now, we've seen some dissipation of political risk in Europe. We've also seen that a resolution of the Ukraine-Russia conflict is on the cards, which is positive for Europe. But here we would like to go into specific sectors, such as, for example, European defense, which is going to benefit from the increase in defense spending. think luxury stocks we also like in Europe, which were still at an attractive valuation multiple, and we've already seen the trough in organic sales growth that happened last year.
All right, Rashmi Garg, Senior Portfolio Manager at Dhabi Capital. Thanks so much for joining us. Still to come, we're going to be live at the Bank of America Investor Summit in Dubai, and we'll discuss risks plaguing the global market with Goldentree founder Steve Tananbaum up next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Paul Allen. Let's get over to Dubai now, where Bloomberg's Guy Johnson is at the Bank of America Investor Summit. Guy.
Yeah, I am. We are here in Dubai. We've got some great guests lined up over the next few hours from the conference. Steve Tananbaum, sitting opposite me now, one of the first guests we are talking to this morning, founder and CIO of Goldentree Asset Management, credit fund. Let's start there. Let's start talking about what's happening in this credit market. Great. Good morning. Nice to see you. Thanks for getting up early and coming and talk to us. There's a lot of uncertainty in the world right now. There's a lot of uncertainty in asset markets. Credit, weirdly, and I spend a lot of my time talking to credit people, seems the most unperturbed by all of it.
Yep.
Why?
So first thing is lots of asset classes are at lofty levels.
Yeah. Credit feels pretty lofty too.
Depends how you look at it. If you look at spreads, yes, top decile in a lot of different parts of credit. If you look at dollar price, much more reasonable. You look at yields, much more reasonable, pretty much second, third quartile. And given valuations tend to be more stretched when the economy is perceived to be doing well and the prospects are perceived to be positive, not surprising that a lot of asset classes are at lofty levels, and particularly credit.
Does that continue? So the argument I hear from a lot of credit people is, don't worry about the spreads. Yeah, they're tight, but okay, so let's park pricing. Let's just talk about absolute yields. Absolute yields are great. You take those absolute yields. Default rates are, even if they ticked up a little bit, aren't going to be a problem. So that's the argument right now. Is that your argument as well? Does that hold water?
No, that's not my argument.
Okay.
Yeah, so if you look at spreads, they're an expression of the incremental return you're going to get after defaults and what the volatility of outcome is.
Yep.
So if you assume you're going to have several years of growth with low default rates, and when you have an economy growing over 2%, historical default rates are less than 2%, then the current spreads justify it. Justify current levels. If you have a more uncertain economy and it looks like growth will be less than 2%, then the current spreads don't justify.
Yep.
So it's really, it goes to what's your prospect for the economy.
What is your prospect for the economy?
We think you're going to have nominal growth of 5%, split between inflation and real growth, 2.5 apiece.
What's the split?
It's 2.5. It's 50-50.
So you think it's a 50-50?
So if it's 60-40 on real growth, the market's going to like that. If it's 60-40 inflation on the nominal, not going to like that.
Right.
And so that's the tug of war here.
So would you rather, so in terms of the way that the Fed should be thinking right now, you would rather the Fed just focused on inflation, making sure that inflation does not become a problem, you think should be the priority right now? Focus on that rather than focusing on growth?
Growth looks pretty good. Now, there's a lot of variables, so I wouldn't just say to focus on one variable. But inflation seems more of an issue right now, and it's certainly been sticky. And if you take the tug of war on information, it looks like it has more of a stable to upward bias with the most recent reports.
Where's the risk? Okay, so let's assume we get higher for longer, given what you just said, higher for longer from the Fed. Let's say they don't cut from here, and the risk is maybe it's the upside. Which areas of credit in a higher for longer world look most vulnerable?
Well, the most vulnerable would be credit that's exposed to floating rate debt, where the free cash flow to debt or their ability to service their debt looks very marginal. So I'd say loan-heavy capital structures, companies that don't do well in industries that don't do well with higher inflation will be vulnerable.
How many of those are there out there?
In terms of capital structures, a lot of capital structures were put together between, call it 2018 to 2022.
Yeah, low rates.
Low rates and floating structure, because it was the cheapest. You have the not terribly different than how the federal government funds itself with short-term rates, because it's the cheapest.
Yeah.
And so those structures are going to be very vulnerable.
Let's talk about the downside. Let's talk about the growth story. There's an argument that's floating around that Elon Musk, Doge, is going to push the economy too hard. That you lay off a whole bunch of federal workers. The federal government is a pretty big employer. That actually you could end up in a situation where the economy kind of rolls over pretty quickly. How high is the risk that Elon Musk causes a recession?
Okay. I think it's like very low in my view. So let me get this straight. The argument is we need to hire more people, not less at government.
Yep.
And that if you look at the growth in government, it's been very significant over the past few years.
You look at the payroll numbers, like every month it's government, big chunk of it.
Yeah. So it's I think it's a argument doesn't hold water with me. In fact, to me, you're going to have a reallocation of resources from inefficient bureaucratic government to different parts of the economy. And if anything, that's going to solve or certainly address a tighter labor market. It'll be slow moving, so it will not be instantaneous, but you have a better prospect for that than we've cut too much from a bloated government. That doesn't seem at this point to really be a credible argument to me.
All right, so the recession risk in your mind at the moment is very low.
In February of 2025, it's low. Things change, but at this point, it looks like the economy is doing well.
So just to wrap this all up, you seem pretty confident. You seem comfortable with pricing. You seem pretty comfortable.
I understand pricing. I wouldn't say I'm comfortable with pricing, but I understand it.
Okay. So what would make you uncomfortable? Okay. So the question I'm really asking is how the market at the moment feels like it's confident, but the veneer of confidence feels like it could be quite thin. Is that the right way?
So, Guy, on what you're saying is the market feels toppy. Yes, it feels toppy. Okay? Yes, it feels toppy. But it's also from where we've come from.
Yeah.
We've had significant tightening recently in the credit markets and material improvement in performance in the equity markets over the last year. So we've come from so we've done well, and this is a consolidation phase. There's also a lot going on with the new administration. And on the one hand, they're trying to do different things against policies that haven't worked. Whether the new policies will be enacted and whether they work, time will tell. But right now, probably the biggest risk is inflation. And that's what we see hurting markets. And in terms of valuations, would I be surprised with a correction? Absolutely not.
Okay. I think we've got it all covered. Steve, great to see you. Thanks for stopping by to see us this morning. We really appreciate it. Steve Tananbaum joining us here at Dubai at the Bank of America Global Conference. Paul, I'll send it back to you.
All right, thanks very much, Guy. Guy Johnson there at the Bank of America Investor Summit in Dubai. Now let's take a look at some of the other stories that we're following. Bloomberg has learned that Alpha Data is likely to price its Abu Dhabi IPO at the top of a planned range. And this as investors pile into the IT services firm that's been a beneficiary of the surge in interest in artificial intelligence. The listing, the UAE's first this year, is expected to price at 1.5 dirhams a share, putting the firm on track for a valuation of 1.5 billion dirhams. Bloomberg understands that Alat, a unit of Saudi Arabia's sovereign wealth fund, has bought 15% of TK Elevator and unveiled a joint venture that will make escalators and moving walkways. This as the kingdom looks to boost domestic manufacturing. The deal gives TK Elevator an equity value of about 12 billion euros. Italian Prime Minister Giorgia Meloni says the UAE will invest $40 billion in the country after Rome hosted a visit of President Sheikh Mohammed bin Zayed. The planned investment will focus on artificial intelligence, data centers, renewable energy and rare earths. They also agreed spending on Meloni's so-called Mati plan to spur development in Africa in a bid to stem migrant arrivals by sea. Okay, let's take a look at US equity futures. They are in positive territory at the moment by about 0.1%. Nasdaq futures pretty flat. We did, of course, get the news in the past couple of hours that the US is considering more restrictions on China chip production. We did initially see some selling in Chinese tech stocks, but now they've recaptured pretty much all of those declines. Still to come, Chinese technology stocks sliding. As I mentioned, President Trump moving further to squeeze US investments in the Asian nation. We're going to have details of that story up next. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. A growing rift despite the hugs and handshakes between President Trump and Emmanuel Macron. The split is evident as Washington breaks with European allies on Russia and Ukraine. Plus, the EU agrees to partially suspend several sanctions on Syria's energy industry and some banks. And Chinese stocks whipsaw after Bloomberg learns the US is sketching out tougher versions of its curbs on China's chip industry. It's just gone 8:30 a.m. Tuesday morning across the Emirates. It's 3:30 Tuesday afternoon here in Sydney. I'm Paul Allen in for Jemana Besetche. Let's take a look at how markets are tracking at the moment. We've got yields on the US 10-year just grinding a little bit lower. We're going to hear from a host of Fed speakers in the coming day in the US, among them Thomas Barkin, Laurie Logan. We'll also be hearing from Michael Barr as well. We've got S&P futures setting up for a positive open in the US as well. We have, of course, heard the news, and we'll unpack that a little bit more in a moment about potentially tougher curbs from the US on exports of chip technology to China. I want to mention Bitcoin as well. It's slipping, although not as badly as some of the other altcoins on the market. We had Ether, Solana, Doge, all off by more than 10%. So crypto not really joining in on the broader rally that we've seen. Also want to mention Nvidia. That's the big one coming up later this week. Earnings from the chip manufacturer are due on Wednesday afternoon, US time. Ahead of that, though, we've got some data from Goldman Sachs. You're seeing on the screen there that according to brokerage desk data, for the second straight week, we've seen hedge funds trimming their risk in tech, media and telecom. Net exposure to the Magnificent Seven now at its lowest level since April 2023, ahead of those key earnings. Let's check in on how markets in Asia are faring now. Avril Hong's in our Singapore studio, charting what's been a wild ride for some of those tech names in the Asia Pacific. Avril.
Absolutely. After a pretty poor handover from Wall Street, we saw tech names in Japan being the drag, and then China joined the session, and we saw a decline of upwards of 4.5% or thereabouts on the Hang Seng Tech. Of course, this is a much-watched gauge of Chinese tech names. For now, though, it looks like investors are able to look past the steep declines in Alibaba ADRs overnight. Trump's salvos against China, where we saw potentially being proposed these Chinese spending curbs on U.S. tech and vice versa, pressuring Mexican officials to impose tariffs on China and maritime fees even. So it's really amazing amid these overtures what we're seeing in Chinese tech names that rebound in the morning session, or at least the pairing of the declines at the start of trade. And there seems to be enough optimism to go around. At least that's what investors seem to think. You think about the DeepSeek narrative that's been governing the trading for much of this year, the Chinese president's meeting with these key business leaders, and then most recently these Alibaba earnings. So much so that investors seem to be able to look past all the negative headlines, and they're really buying the dip in Hong Kong. If you look at the southbound flows, I think if we pass 26.6 billion Hong Kong dollars today, it would be a record. So really interesting to keep an eye on these market moves. Paul?
All right, Avril Hong in Singapore. Let's get a little bit more on this news that the Trump administration planning to expand efforts to limit China's tech advancements. Now, this would potentially include tougher chip curbs and pressuring allies to escalate restrictions. We'll get some more details now from Bloomberg's China correspondent Min Min Lo. So, Min Min, tell us more. What's the latest on these discussions?
So the Trump administration is looking to expand the existing regulatory regime, and according to our sources, Trump officials have been meeting with their counterparts in Netherlands and Japan to discuss disallowing the engineers from ASML, from Tokyo Electron, from servicing the chip-making gears in China. And of course, when these services are halted, that could cause the chip-making gears to lose their functionality. And aside from that, Trump officials also looking to tighten the noose on these chip restrictions, including the chips that were specifically designed for China in order to meet the pre-existing restrictions that had been imposed by the Biden administration. And this comes after Reuters had reported that many Chinese companies had in fact been stockpiling that H20 chips. Those are the NVIDIA, the scaled-back version of those chips that were tailored for the Chinese market, and that's on the back of increased demand given the DeepSeek-related activity. And on top of that, U.S. officials reported mulling further sanctions on specific Chinese companies, for example, Changxin Memory Technology, which is at the forefront of the Chinese tech race, potentially more restrictions on SMIC, which is the major manufacturing partner for Huawei as well. And overall, there has been that pretty complex sort of AI diffusion rule where the U.S. has divided the world into 3 different tiers, imposing different caps in terms of computing power that can be exported to these countries. And some officials looking to lower the threshold for these caps where computing power can be exported without additional license. So again, expanding the restrictions there, and already we're getting rebuke from the likes of NVIDIA that had been hoping that the Trump administration would have a lighter regulatory touch. But it looks like we are seeing this sort of game of cat and mouse still playing out with the new administration.
All right, Bloomberg's China correspondent Min Min Lo, thank you. Well, Bank of America's most recent China consumer survey found the consumers are keeping their purse strings tight as the nation struggles to stimulate domestic consumption. Let's get back to Dubai now, where Bloomberg's Guy Johnson is at the Bank of America Investor Summit. Guy.
Paul, thanks very much indeed. Yes, I'm joined now by Helen Qiao, Chief Greater China Economist at Bank of America Global Research. We've just been hearing about the new chip curbs that are being announced by the Trump administration. We'll talk about the consumer as well. Let's start off with the Trump administration. Is what is happening as you anticipated? Are there any surprises so far in terms of what's being targeted, the timing, the scale? Any surprises coming out from the White House?
Well, thank you for the question. I would say the first 10% on Chinese imports into the U.S. were completely consistent with our baseline scenario. We were one of the few investment banks out there basically saying that it's not going to be 60% upfront. Instead, we're going to see first 10% in first, second quarter of 2025, and then followed by another 10%, maybe in 9 months' time. So that, I think, is completely in line. But at the same time, I was a little bit surprised by the going forward and then kind of retraction of the de minimis rule, repealing kind of actions. So we thought that it would be pretty challenging from a logistics perspective to implement it, given what is happening in Europe. But I guess that the president still went ahead with it and then decided to pull it back after he finds out that it's probably not feasible right away. So we have the view that given the backdrop, this is probably going to be challenging. He will probably have to change to something else.
Okay, so let's talk about the broad packages, the package that we've been kind of slowly seeing unfolding. I say slowly, it's actually happened quite quickly. Has it come earlier than anticipated? Has what you anticipated come in the sort of timeline that you anticipated?
Well, in terms of timeline, I would say that this is slightly earlier than we thought because we thought, there would be more discussions regarding how much and also by when. And then after the debate and by the time that there is a consensus, it will probably be second quarter this year. But I guess right now there is no consensus needed. And the executive order would put everything in place right away. And therefore, I think that was earlier than we originally expected. But that said, if you look at the investment restrictions over the weekend that was talking about, and also the recent chip ban, I think this is basically suggesting that actually the U.S. government is probably getting closer to a negotiation with the Chinese side. This is because that they probably want to, put in more chips and basically show that, okay, here's more for you to lose if you do not, make a concession.
When does that deal come? If there is a deal to be done, if there is a negotiated solution to this, what does it look like?
According to President Trump, there's going to be a grand and better deal, right?
Okay, so what does a grand and better deal look like? What will the Chinese look for in those negotiations, do you think?
I highly suspect that what goes into the deal is going to be a combination of many things. It's not going to be just the Chinese buying more products from the U.S., and it will not just be TikTok, for example. Yeah. It's probably going to be a combination of multiple different things that the two sides would have to agree on. One important issue, in our view, is probably to address the bilateral trade imbalance. So China would have to promise to buy more. Well, so during the first phase, or the first term of the trade war, there was already such a deal, but that was primarily based on China's promise to buy more from the U.S. That would not materialize later on because of COVID. So if they start from somewhere around there, I would say the focus this time is going to be energy products, because after all, without the next election in line, there is not as much attention paid on the agricultural products. So oil and gas purchase from China, I would say, is probably going to be the most important highlight for the deal.
Chinese stock market doing really well. Chinese economic data not doing so well. Which one of those two should I be focusing on? What's the head fake? Does the data catch up with what the markets, or are the markets going to retrace back down to the data?
First of all, this is a bleak season for macro data.
Okay.
Because this is Lunar New Year, even if we look at some of the data that look good, for example, CPI inflation for Jan, we cannot say that this is great because we knew this was largely distorted by the Lunar New Year. But secondly, this is also a window, relatively empty, I would say, for policy easing, because we're waiting for the MPC next week. But at this point, the market rally was more based on bottom-up information, such as technology, DeepSeek, for example, Unitree, as well as very exciting news such as Ne Zha 2, which is the animation movie, the highest global grossing animation movie that was put on actually less than a month before. So all these excitement, I think, got people to think that, well, China, there is some more hope for China to get long-term growth back.
Is technology going to be the next growth driver? I'm looking at Xi Jinping meeting Jack Ma. I think these are incredible kind of events that are taking place right now. Is that Beijing's new focus to drive growth in the Chinese economy?
I would say so. The symposium that she held with the private sector leaders were dominated by technology sector business leaders. So I think there is a strong message there. And at the same time, I think that what it does, from an economist point of view, is to offer the incentives for the technology to be adopted, so that private sector people would be assured that they could make investment and then keep their return. Right? So I think that the message over there is quite clear. In a country with the technology in place and the largest domestic market in place, what they're needed is the incentive to do so. We mentioned that actually China is lack of positive incentives for some time, and this is a good change. Okay, so
final question. China's focused on technology. The government's behind it. You're going to be able to keep your returns. It's looking good. I'm sorry about the little fly. Talk to me about kind of are there more DeepSeeks out there that we're not here in Western markets figuring out? Because DeepSeek caused huge, like NVIDIA reports this week, huge amounts of volatility around DeepSeek. Are there other kind of DeepSeek-like products you think out there that China is innovating quickly enough that will have a global implication, particularly for US markets?
I would guess with the right incentives in place, there is a bunch of DeepSeek and alikes, right? You probably have heard something called the six little dragons out of Hangzhou. So DeepSeek, Unitree are only two out of the six that the global audience has heard of so far. And there are many others waiting as well. So I believe that there are other technology progress to be unveiled to the market, so that investors will realize that such labor-saving technology is for real, and it can be applied at a relatively low cost across China in multiple industries. And that, I think, would be the fundamental shift in the expectations for long-term potential growth to come back.
Helen, it's great to speak with you. Thanks very much for stopping by to see us.
Thank you.
Great conference. Thanks very much indeed for inviting us. Helen Qiao joining us, Bank of America. Paul, back to you.
All right, thanks very much. Bloomberg's Guy Johnson there at the Bank of America Investment Summit in Dubai. Still to come, Elon Musk's SpaceX seeks to deploy Starlink terminals in US airspace. More on what it means for Musk's business empire next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Paul Allen. Bloomberg understands Elon Musk's SpaceX is seeking to deploy Starlink satellite internet terminals to help upgrade the US Federal Aviation Administration's national airspace system. Now, the effort raises questions about conflicts of interest for Musk's business empire, as well as the future of the $2 billion Verizon contract. Let's bring in Bloomberg's Asia transport reporter Danny Lee, who's in Hong Kong. So, Danny, another sign, perhaps, of Elon Musk's growing influence. What more do we know?
Yeah, Elon Musk growing his influence into the US government increasingly, and this time it involves the US Federal Aviation Administration, and that's according to a Bloomberg scoop. And arguably, the FAA is one of the most scrutinized agencies of the moment. So what's happening and what we know is that SpaceX is going to implant the Starlink terminals into the FAA to help improve and boost the critical IT infrastructure in the FAA, and that would help overall improve and help support the national airspace system. But this does raise, as you say, a lot of questions about increasingly that conflict of interest between Musk and his business ties and the political ties that this entails and involves. And obviously not least for the fact that this existing contract, $2 billion worth of it with Verizon, and that remains to be seen what happens as a result of that. But this deal involves some 4,000 Starlink terminals that Musk personally had approved, and going forward, now these will be tested. So this does seem to have a long shelf life potentially in terms of this relationship. But again, this all is to improve the US airspace system, not least after the mid-air collision in DC in late January.
So what's Elon Musk had to say about the reporting?
Well, Elon Musk has, in effect, confirmed parts of it, effectively trashing Verizon, saying its product was not up to standard, and this is where Starlink and SpaceX comes in. And the FAA has also confirmed that they will be doing some testing with Starlink as well. And so, given the scrutiny over the US airspace system, the reliability, and not least after the safety accidents and incidents in recent months and years, there has been a concerted effort, particularly under the Department of Transportation, to really push for changes and for improvements. And so this is kind of the culmination of all of those kind of pushes over the recent weeks, in fact.
All right, Bloomberg's Danny Lee, thank you. Still to come, amid a civil war and political unrest, Sudan's gold industry saw a rebound in 2024. We'll have more on the Northeast African nation next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Paul Allen. Sudan's gold industry rebounded last year as the government took steps to bolster revenue amid a civil war. Some of the measures included mining deals with companies from China, Russia and Qatar, and lowering taxes and fees for artisanal miners. For more, Bloomberg's Ondera Oganga joins us now from Kigali, Rwanda. So Ondera, tell us some more about the gold industry rebound.
Hi, Paul. So Sudan produced 65 tons of gold, bringing in $1.6 billion in terms of revenue, compared to 2022, where they produced at 4.5 tons but made $2.2 billion in revenue. But for context, this was before the war began. So if we look at the revenue gains in 2024, it signals that there's a surge of gold prices in the international market, and that is beginning to reflect in Sudan. Outside of ramping up production, the government is also trying to expand the sector. Like you mentioned in the intro, they're trying to rope in artisanal miners and making them formalize their businesses through lowering of taxes and also fees. And we're seeing artisanal minings contributing a large chunk to the gold that was produced, accounting for 53 tons, while concession companies produce about 12 tons of gold. Outside of this, the government is also trying to strike a new deal with Qatar to build a new processing plant for gold in the Gulf state. And they're trying to reduce their over-reliance on the United Arab Emirates that has been processing their gold, because the contention here is that the army is accusing UAE of supporting RSF, allegations that the UAE has denied.
So what's the intersection between the gold and the ongoing war?
That's a good question, Paul. Gold has always been at the heart and the center of this conflict. The gold that has been smuggled outside of the country, its proceeds have been used to buy guns, to buy drones, and also to buy missiles. And when the war broke out, we saw many of these homes being invaded, and people lost their gold that they were using to store value in their homes as they were fleeing when the war was breaking out in Sudan. If we also look at RSF, in 2017, they seized a mine, used proceeds from that gold mine to arm themselves to the teeth, sold this mine to the government, and later on seized that mine. They've also been accused of breaking into the gold refinery and stealing gold worth $150 million. But the army is also not an innocent bystander. Ever since the war began, they've been ramping up production of gold in areas that they're controlling. Companies affiliated or controlled by the army have also been exporting gold, and last year they exported more than a ton.
All right, Bloomberg's Ondero Oganga in Kigali, Rwanda. Thank you. Well, Kenya Airways plans to acquire bigger cargo aircraft as intra-African trade expands and exports from the region bounce back from the pandemic slump. The partly state-owned airline added 2 Boeing 737-300s to its 2 freighters and is planning to add even bigger aircraft to improve its economies of scale. KQ, as the airline's more commonly known, last year reported a first-half profit for the first time in a decade. And Kenya plans to sell new dollar bonds to finance the repurchase of $900 million of euro bonds, which are due in 2027. Kenya's been rearranging its debt since its finances came under severe pressure last year as a $2 billion euro bond payment drew close. The IMF says Angola's high external debt service and oil dependence are weighing on the country's sustainable growth and underscores the urgency for structural reforms. The international lender says the country's economy recovered in 2024 and is expected to continue improving, but risks remain high, stressing the importance of a return to a fiscal consolidation path, including reforms of fuel subsidies. Well, Bloomberg has learned that Spanish lender BBVA is in talks with Angola's government to provide a loan of as much as $1 billion. The loan would be for public investments in a range of sectors as the oil-producing African nation seeks to diversify its economy away from oil. Okay, let's take a look at how some of these key assets are tracking, including oil. We've got crude right now. Well, we've got stocks futures here at the moment. We're looking ahead to the open in Europe. Currently a little bit of softness for Euro Stocks 50 futures. We'll be keeping an eye on defence stocks, though. I'll bring you some more on that at the top of the next hour. Looking ahead to the open in the US, however, E-mini futures poised to open a little bit higher. Crude prices, as I mentioned, pushing a little bit higher as well. We saw the oil price there, I believe Brent was hovering around 75.19. Bank of America sees OPEC restoring more production in April. RBC, though, disagrees, so there's still a fair bit of disagreement in the market over the whole supply dynamic when it comes to oil. Do stay with me for the next hour of Horizons Middle East and Africa. I'm Paul Allen. This is Bloomberg. This is Horizon's Middle East and Africa. Our top stories this morning. A growing rift despite the hugs and handshakes between President Trump and Emmanuel Macron. A split is evident as Washington breaks with European allies on Russia and Ukraine. Plus, the EU agrees to partially suspend several sanctions on Syria's energy industry and some banks. Chinese stocks whipsaw after Bloomberg learns the US is sketching out tougher versions of its curbs on China's chip industry. It's just gone 4 p.m. Tuesday afternoon here in Sydney. I'm Paul Allen. Welcome to the second hour of Horizon's Middle East and Africa. Let's take a look at how some of the key assets are tracking at the moment. We've got US futures pointing a little bit higher at the moment. Yields kind of pulling back a little bit as well. We've got the oil price showing some gains also. And I did mention a moment ago that we've got Bank of America forecasting OPEC Plus restoring a lot of supply by April, 150,000 barrels per day. Some disagreement, though, from RBC. And as we'll get to in a moment, the EU partially lifting its sanctions on Syrian oil. So a number of catalysts there for the oil price. Brent right now 75.19. Bitcoin easing off. It's had a bit of a rough start to the year, but doing a lot better than some of the other altcoins on the market. Ether, Solana, Doge, all down more than 10% so far this year. So even though we've seen a number of assets rising, the love not really spreading to crypto at the moment. Tell you what is gaining at the moment, though, European defence stocks. Now, this is interesting. It's something one of our guests last hour raised as well. Rashmi Garg at Dhabi Capital pointed to EU defence stocks as something to keep an eye on, and that rally has been continuing. German defence firm Rheinmetall surging 14% yesterday. That did help lift Frankfurt to a new record high. The Goldman Sachs Group index of European defence stocks hitting a record high as well. And of course, this comes against the backdrop of the US asking European nations to spell out what security guarantees and equipment they would offer Ukraine to ensure a lasting peace settlement. We'll get more on that story in a moment. But for now, let's check in on how markets in Asia are faring, because it's certainly been a very interesting day. Avril Hong's in Singapore. Avril.
Yeah, Paul, geopolitics also playing out in the Asian session. Chinese tech names are front and center. And we saw the Hang Seng in the morning session declining as much as 4.5% on the tech gauge. But look at how it's faring now, starting the afternoon session with mild gains. It's a bit of a head scratcher because you consider how Trump came through with his most sweeping, forceful action against China. Today, we're hearing about potentially these tighter curbs when it comes to China's access to chips, and specifically also potentially for Chinese chip names. Yet SMIC declined 6% earlier, managing gains at the moment. Maybe investors are looking at these chip curbs and saying they're not as bad as expected. Maybe there's also enough air optimism to go around. We're also seeing mainland investors buying the dip in Hong Kong. Southbound flows are really going high today. So maybe that's also contributing to what we're seeing. Some idiosyncratic plays as well. Li Auto extending gains from earlier, 14% up now. And this is after it unveiled photos of its first all-electric SUV. So really interesting moves, as I say, in the Chinese tech space today. Paul.
All right, Avril Hong in Singapore. Thank you. Let's stick with car sales. We're just getting some data from Europe. Breaking news for you. European car sales are declining 2.1% in January to just under 1 million cars, 995,271 to be exact. Electric vehicle sales, meanwhile, are rising 37% in January. So that's an interesting picture. And it gets even more interesting when you dig into the stats, because despite that big rise in EV sales in January, Tesla car sales fell 45% in Europe. As for Tesla's rivals, EV registrations soared. So a lot more electric car sales in Europe, but Tesla not really taking part in that sales rally. You can draw your own conclusions about that. Well, the US has withdrawn its previous stance condemning Russia's invasion of Ukraine at the United Nations, and that's a stark policy reversal from President Biden's administration. and is another blow to ties with the EU. Now, this comes as French President Emmanuel Macron visited Trump in Washington in an effort to get Europe back to the table in talks with Russia. Joining us now is Greg Sullivan, Bloomberg's Russia economy and government editor. So, Greg, is the US completely abandoning Europe now in favour of Russia ahead of negotiations?
Well, I can say that watching the U.S. vote with Russia and Belarus and North Korea against its Washington's European allies was quite a sight. It's quite an image. And it does appear that there is a deep break in the Europe-U.S. relationship. Now, with Trump, we know that he has been careful not to criticize Russia, and he seems to be aligning U.S. policy towards that. But more broadly, what's at stake is that Trump appears not to think that he needs to talk to Europe in resolving this Russian conflict. He believes that he can talk directly to President Putin and that Europe is a secondary player at best. Now, obviously, French President Emmanuel Macron is there. The door is still open to talks with the Europeans, but whether he can succeed in getting Europe back to the table is a big question.
So what are President Trump's aims here in this what appears to be a realignment of U.S. policy?
Well, for Trump, and he said this pretty explicitly, he wants a swift end to this conflict. He wants to end the fighting in Ukraine and Russia, and he appears willing to do it on terms that are more favorable to Russia. For Trump, it doesn't appear that Ukrainian security is a necessary or priority in ending this fighting, but forcing both sides to the table and getting them to stop the fighting. Now, that's a tough goal, and he does appear more willing to talk to Putin, and he's already said that NATO won't be peacekeeping force, which would be a big thing in helping to bring Ukraine to the table. But again, it's just his goal of bringing a swift end to the fighting. And it looks like Europe and Ukrainian priorities might not be at the forefront of his mind in that.
All right, Greg Sullivan, Bloomberg's Russia economy and government editor. Thank you. Well, the European Union's agreed to partially suspend several sanctions on Syria's energy industry, including scrapping bans on importing crude from the country and on exporting technologies to the oil and gas industry. The bloc says the move aims to facilitate engagement with Syria and to allow for associated financial and banking transactions. Joining me now is Paul Wallace, who leads Middle East, North Africa economy and government coverage. So, Paul, is this going to be enough to help aid Syria's recovery?
Hi, Paul. As far as the new Syrian government is concerned, it will certainly help. And this is the type of thing they've been prioritizing since they toppled the regime of Bashar al-Assad last year. They are desperate to give some respite to the war-ravaged economy, which has been completely devastated in the last decade or more since the civil war started. So I think this move by the European Union to start or to agree on the easing of sanctions will definitely be welcome in Damascus.
Well, at the same time, we've got Israel saying it's carried out what it's calling targeted raids in Syria's buffer zone. Can you tell us some more about that?
Well, this is something that in the long term could lead to increasing tension between the new Syrian government and Israel. The bigger picture is that Israel is very wary of Ahmed al-Shara, the president, and his government, given its Islamist roots. And soon after Assad was toppled, it moved troops beyond a Syria-Israel demilitarized buffer zone. It said it's doing that for defensive measures, but it's slowly sort of ratcheting up the rhetoric against the Syrian government. It's now calling for southern Syria, near where Israel is, near the Israel border, to be demilitarized. This is the type of thing that I think could cause tension between the two countries to rise quite a bit from here.
All right, Paul Wallace, who leads our Middle East, North Africa economy and government coverage. Thank you. Well, the global economy is at risk of splintering under US President Donald Trump's policy onslaught. The head of South Africa's central bank is issuing that warning. The banker making the comments ahead of a group of 20 meeting of finance chiefs and central bank governors in Cape Town. Meanwhile, South Africa's Treasury Director General says they aim to review G20 processes.
The operational processes of the G20 have rarely been reviewed. In the coming months and following the discussions this week, The South African presidency, working with the G20 membership, will for the first time conduct a review of these processes and consider how to improve and strengthen them.
All right, joining us now is Jennifer Zabasajja, Bloomberg's chief Africa correspondent. Jen, tell us more about what was said, what can be done to head off this problem.
Right, Paul. I mean, that was just one of the many agenda items that we're hearing is going to be the focus here for finance ministers and central bank governors that are convening in Cape Town. We should note the other one that you were mentioning there from the South African central bank governor is fortifying economies that make up the G20 and others to withstand a lot of these shocks that are coming left, right, and center. Now, listen, we are here in Cape Town for these meetings. Monday and Tuesday is focused on the deputy central bank governors and finance ministers. And Wednesday and Thursday, we'll hear from a number of finance ministers and central bank governors just about what they are doing to fortify their economies from a lot of these shocks. And I think we should note that many of these leaders have told us, even last week at the foreign ministers meeting, that they're convening under the theme of solidarity, equality, and sustainability. But also, they have many of their own individual issues. President Ramaphosa of South Africa, namely, has talked about his inclination. He wants to really reform a number of these multilateral development banks and also address things like debt and debt restructuring because that is an issue for a number of the economies that are on the African continent and make up the global south. So our expectation is that we'll continue to hear more of this from leaders and potentially try to see where they can find some common ground in terms of dealing with the uncertainty of the global economy. So we'll be speaking to a number of those chiefs, and we should note that this G20 blocking accounts for about 85% of the world's economy. So these are substantial players in the global economy right now. So a lot of questions right now about the uncertainty with tariffs and also about how they are planning to address them together in their own domestic agendas, but also what they can do internationally to work together.
All right, Jennifer Zabasajja, Bloomberg's chief Africa correspondent. Thank you. Still to come, we'll take a look at markets on how they're moving as Trump doubles down on tariffs on Mexico and Canada. Also, chip curbs, new ones on China. DPAM Indosuez Wealth Management is going to share their investment strategy next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Paul Allen. Asian stocks fell after President Trump's move to curb Chinese investments and proceed with tariffs on Canada and Mexico, prompting investors to trim risky bets. Joining us now is Peter de Coensel, CEO of Degroof Petercam Asset Management. Peter, I'm wondering, when you see action like this, which I think is going to become a familiar scene over the next 4 years, how do you act? Do you look through the noise and buy the dip? What do you do?
Well, first of all, we tend to take a helicopter view and effectively look through the noise. We've seen that between the Trump election early November and effectively last weekend, the Germany election outcomes, visibility was very low, and that made for markets to price very prudently. Effectively, we did not see any excess positioning. Now with, I would say, the strategy on the tariff, the various tariff wars out there, it's clear that the aggressive stance taken during the election campaign will be treaded a lot weaker across many countries. So overall, I believe that visibility will become more pronounced going forward. And that's already reflected in rate markets, credit markets, global fixed income in general, which given the level of rates, acts very disciplinary to markets. and the pockets of value that investors have been tapping of late, will normally this trend should continue, and effectively, Chinese equities or European equities might fare well, given the historic discount on a relative basis versus the US.
Yeah, you mentioned that you take a helicopter view in these sorts of situations. If you are looking to get long, what sort of assets, are there any sectors that you favour in this kind of environment?
Well, effectively, I repeat, as coming into 2022, global rates were lifted quite aggressively. And we see in some parts of the market, this protracted, mainly Japan, rate hiking cycle is continuing. But we believe that higher yielding bond sectors offer quite some long-term value, be it in emerging market debt, local currency, be it in some higher quality, I would say, high yield. There is definitely value. On the other hand, in terms of equity, we believe that a balanced construction across regions, across US, which is still leading in technology, but rather look at, I would say, the second range of names, and maybe look for the mid-cap or even small-cap names, be it in Europe, be it in the US. Another maybe contrarian view is that in order to diversify into a balanced portfolio, we have been looking at gold. Gold will remain, I would say, a diversification play. But if you look beyond gold, one should also look into the silver market. There, substantial shorts have been built, and potentially that might diversify into that complex. On the other hand, and maybe as a last contrarian view, there's European real estate. We've seen that the steady path the ECB is on, will be maintained. We believe by year end we will be close to 2% deposit rate, and maybe potential for one extra cut even before year end, dipping below 2%. Given the relative deep discounts that are priced onto listed real estate in Europe, there we see also quite some nice potential.
You did mention there the US lead in tech, although one thing we've learned in the past few weeks is Chinese tech companies have been quite adept at innovating their way around some of these curbs. Would you be tempted to add that to your list of contrarian views? Is Chinese tech something you're looking at, notwithstanding the pressure that's being applied on it by the US administration?
Yeah, again, for sure. There has been already a hefty reaction in Chinese tech. But more overall, we believe that looking at the Chinese equity markets, that there is a more broad-based recovery at play. So I believe that public authorities are watching across sectors and will effectively intervene to promote internal demand. So we all know that this is ongoing. This effectively started over Q3 last year in earnest. And we believe that smart investors will continue to allocate not only for the specific tech sector, but clearly what the US is trying to do, and is be less reliable on foreign I would say, competitors, China is going for a tit-for-tat strategy, and in that respect, given the very attractive valuation historically, we believe that China's equity in general will be a nice diversifier.
All right, Peter de Coensel, CEO of Degroof Petercam Asset Management. Thanks so much for joining us with your views today. Still to come later this hour, the Democratic Republic of Congo suspending cobalt exports for 4 months. We'll discuss what that means for the international market. Stay with us. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Paul Allen. Bloomberg has learned that Alpha Data is likely to price its Abu Dhabi IPO at the top of a planned range. This as investors pile into the IT services firm that's been a beneficiary of the surge in interest in artificial intelligence. The listing, the UAE's first this year, is expected to price at 1.5 dirhams per share, putting the firm on track for a valuation of 1.5 billion dirhams. Bloomberg understands that Alat, a unit of Saudi Arabia's sovereign wealth fund, has bought 15% of TK Elevator and unveiled a joint venture that will make escalators moving walkways. And this as the kingdom looks to boost domestic manufacturing. The deal gives TK Elevator an equity value of about 12 billion euros. Microsoft has cancelled some leases for its US data center capacity. While the reasons remain unclear, TD Cowen suggests it may be due to an oversupply position. While Microsoft reiterated that it plans to spend $80 billion on AI data centers this year, cancellations have raised concerns if it's securing more computing capacity than it needs. Bloomberg has learned that Tesla is preparing a software update for customers in China that will offer driver assistance capabilities, which are similar to the full self-driving available in the US. The system is expected to guide vehicles to exit ramps and intersections, recognize traffic signals, make turns, and handle changing lanes and speeds. The capabilities will be deployed to customers in China who have paid close to $9,000 for what Tesla calls full self-driving. Indian billionaire Gautam Adani says his group is planning almost $13 billion of new investments in India, and this will fund projects ranging from airports to mining to thermal energy. The investment plans come amid legal challenges that it faces in the US, as well as a string of project setbacks in countries including Kenya and Sri Lanka. Here's a look at how equity futures are tracking for the US, better by about a fifth of 1%. The pullback a little bit. European stocks futures, meanwhile, are looking kind of flat. In a moment, we're going to speak to Bryon Lake, Chief Transformation Officer at Goldman Sachs Asset Management, on the rise of ETFs. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. A growing rift despite the hugs and handshakes between President Trump and Emmanuel Macron. The split is evident as Washington breaks with European allies on Russia and Ukraine. Plus, the EU agrees to partially suspend several sanctions on Syria's energy industry and some banks. Chinese stocks whipsaw after Bloomberg learns the US is sketching out tougher versions of its curbs on China's chip industry. It's just gone 4:30 Tuesday afternoon here in Sydney. I'm Paul Allen. Let's take a look at how some of the key assets that we keep an eye on are tracking at the moment. We've got US futures pointing a little bit higher. They've slipped back a little bit from where they were. We've got the yield on the 10-year also holding pretty steady, 4.37% approximately. Let's call it 4.38. The oil price holding pretty firm at the moment as well. We've got differing views on what's going to happen with the supply picture. Bank of America sees OPEC Plus actually increasing supply in April, although we'll see if that actually happens. Now, we're keeping an eye on Bitcoin as well. We've seen a little bit of retracement in crypto assets. Bitcoin's actually doing better than some of the altcoins. Solana, Ether, Doge, all down by more than 10%. We did have Strategy, which is a self-styled Bitcoin treasury company, buying $2 billion worth of Bitcoin over the past 7 days, but it's not really doing a lot to prop up a market that's struggling for some conviction at the moment. Let's take a look at how markets in Asia are faring. Meanwhile, Avril Hong is with us in Singapore. Avril.
Yeah, Paul, we've been talking about China a lot today, so let's just shine the spotlight on Japan. It's after all back from a long weekend and it's leading the losses in the Asia Pacific. This is against the backdrop of those concerns surrounding export-related names after questions swirled surrounding US growth, that poor showing and performance on Wall Street, and then the tech names. Those are the ones that are really getting hard hit today. And this is against the backdrop of these AI narrative concerns when you have the likes of Microsoft ending leases on data centers. That raises question marks about the rally we've been seeing in AI stocks. And then, of course, more recently today about US restrictions potentially tightening them on China's access to chips, so a bit of collateral damage in the way of Japanese chip names. You're seeing that reflected in Tokyo Electron. The bright spots today in Japan, Marubeni and the other Japanese trading houses. Marubeni, for example, we're seeing a lot of volumes behind this surge, about 8 times the 20-day average. And this is, of course, following on from Berkshire Hathaway saying that they're going to up their stakes in some of these Japanese trading houses. Paul.
All right, Avril Hong in Singapore. Thank you. Well, gold has hit successive peaks this year, driven by concerns over US President Donald Trump's trade and geopolitical agendas. Goldman Sachs has raised its year-end target to $3,100. The bank says that central bank buying is among the key drivers here, as well as expanding ETFs. Well, joining us now is Bryon Lake, Chief Transformation Officer at Goldman Sachs Asset Management. Bryon, for people who don't have a large safe or not very strong arms, an ETF is a pretty good way to get exposure to gold at the moment. What sort of interest are you seeing?
Yeah, no, you're exactly right, Paul. A lot of interest in gold right now just because of the points that you made. Plus, you could layer in inflation, you can layer in diversification. On top of that, you've got many of the major benchmarks near their all-time highs. And so with an interesting kind of geopolitical landscape and some of the risk that I think investors are looking at, I think they're looking to diversify away maybe from some of the equities that had nice runs over the last couple of years into some commodity exposures to balance their portfolios.
Now, of course, a lot of the people we speak to on our shows don't particularly like gold because it doesn't yield anything. It just kind of sits there. But that notwithstanding, do you anticipate that some of the factors that have driven gold to record highs this year are going to endure for the next few months, possibly longer?
Hard to predict. I think that people are investing to kind of express their views and certainly telling us that. I think to your point earlier, the ability to get exposure to gold through the exchange traded fund wrapper is definitely a benefit for investors to build portfolios that they think are positioned well, despite the outlooks that we're seeing in some of those areas. So the ETF actually is a great advent to help investors get exposure to markets and build a portfolio that expresses their views on markets. And so whether it's gold or whether we're seeing obviously increased adoption of fixed income ETFs as well. I think that you're going to continue to see the growth of the ETF space, and gold is just an example of that.
Yeah, can you tell us a little bit more about some of those opportunities that ETFs are offering at the moment? I mean, fixed income is a very good example. What sort of inflows are you seeing into those sorts of ETFs that track tips, assets of that nature?
Yeah, I mean, if you look at the ETF landscape, you've seen assets under management double every rolling 5 years for the last kind of 30 plus years. So investors are definitely embracing the exchange traded fund wrapper. You're seeing flows really in all asset classes as investors transition from holding individual securities, whether it's tips or individual stocks, into expressing their views through an ETF. gives them immediate diversification, gives them liquidity because it trades on exchange. We at Goldman are working on building out our capabilities there as well, as we see a lot of interest in active strategies to be delivered through the ETF wrapper. So of course the ETF is benefit rich. We talked about that with gold. Trades throughout the day. It's transparent. It tells you what you own. On the other side, investors are looking for active managers that can help manage risk, that can help outperform or give you the unique exposure that you're looking for. And so we're building out our capabilities there. And we've seen substantial growth in that. So like I say, the overall ETF landscape has grown pretty rapidly. The active ETF landscape is growing even faster. So 20% CAGRs over the last 2-3 years. Even though active only makes up about 5% of total ETF AUM, we're seeing it account for about 20% of the net flow. So investors really starting to embrace active ETFs as well.
Yeah, this is part of Goldman's strategy, is to become a leading provider of active ETFs in Europe. Can you tell us a little bit about the competitive landscape there, though? You're not alone.
Yeah, no, I mean, to me, it starts with us for driving investor outcomes. So, we've got incredible investment capabilities. Some of our fixed income strategies we've been managing for 3+ decades. They have incredible track records, known investment process, portfolio managers that are really experts in that field. We've got over 2,000 investors globally. We manage $3.1 trillion across our entire franchise. And so taking our best investment capabilities and then delivering them through the ETF technology is really where we're seeing the innovation. Investors are looking to us to do that. And so we've been building out our franchise there. So we do have a number of active capabilities available in the UCITS ETF structure. We've launched 10 in the first quarter, and we plan to continue to serve clients in that way.
Bryon, before we let you go, I've got to ask, you've got an interesting title, Chief Transformation Officer. Can you tell us a little bit more about that? What exactly is that role?
Yeah, thanks, Paul. The way that I think about that is the asset management industry is going through a rapid transformation. The growth of ETFs, the growth of active ETFs, the growth of alternatives, private assets, being adopted in retail portfolios as well as institutional portfolios. And so, I get to work with the team across Goldman Sachs to make sure that we're positioned to navigate that transformation and that we're serving clients on that journey. And so really thinking about the entire organization and what we can do to deliver and serve our clients in that way. And it's been a thrill to do that. Obviously, our clients know Goldman, know the organization, sometimes don't realize that we have so many capabilities on the asset management side. And so making sure that we're delivering those to clients and navigating this transformation is what I get to spend my time doing.
All right, good stuff. Bryon Lake, Chief Transformation Officer at Goldman Sachs Asset Management. Thanks so much for your time today. Well, the Democratic Republic of Congo is suspending cobalt exports for 4 months to address oversupply on the international market. The country's cobalt production has soared in recent years, causing supply to outpace demand and prices to drop. Joining me now for more is Bloomberg's William Close in Johannesburg. So, William, talk us through this suspension. Why has Congo done this?
Morning, Paul. Yeah, so the Democratic Republic of Congo is all important for the cobalt market. It produces about 3/4 of the mine supply into the market. And prices have been very low in a period in a glut. I think we calculated yesterday that the prices are about as bad as they've been in 20 years. So the president of Congo asked his government to come up with policies to arrest this situation. And a year later, they've moved very, very swiftly. They brought in new powers for a regulator, and they've imposed a 4-month ban. First of all, they hope that that will go some of the way to address this oversupply, but also it's sort of giving them some time. They've given themselves 3 months to come up with a decision on whether to extend the ban, but also to develop policies that will bring balance back to the market. An export quota is under consideration, but also they're considering stuff that would encourage more value-added processing in country and sort of put a permanent floor under the price.
So who's going to be most impacted by these moves? Where's the market going to feel the pinch?
Without any question, the company that is impacted most by this is the Chinese miner CMOC Group. Glencore was the top producer of cobalt in the world and from Congo for years, but then it was overtaken by CMOC in 2023. CMOC has two large mines in Congo, and it's been ramping up production and now produces about 40% of, more than 40% of global production. So the company that is most in the sort of firing line here is definitely CMOC. The two biggest producers after that are Glencore and Eurasian Resources Group.
So what's the future of Congolese cobalt output? I mean, this suspension's not going to last forever. What's the impact going to be on the on not just the supply side as well, but potentially for consumers?
Well, so this decision took miners and traders by surprise. No one really knew it was coming, but I've encountered quite a lot of skepticism already, and that skepticism is probably in three parts. The first is that there's such a lot of inventory out there that a 4-month ban might not make a huge dent in it, although those stockpiles will presumably start to be drawn down. The second is that perhaps people wonder about how effectively the Congolese government officials on the border will enforce and police this policy. And the third is what is to stop these mining companies just flooding the market as soon as the ban is lifted, and then we're back where we started. So those are really the points that have been raised in the conversations I've been having.
All right, Bloomberg's William Close, thank you. Well, Kenya Airways plans to acquire bigger cargo aircraft as intra-African trade expands and exports from the region bounce back from the pandemic slump. The partly state-owned airline added 2 Boeing 737-300s to its 2 freighters and is planning to add even bigger aircraft to improve its economies of scale. KQ, as the airline's more commonly known, last year reported a first-half profit for the first time in a decade. Kenya plans to sell new dollar bonds to finance the repurchase of $900 million of euro bonds due in 2027. Kenya's been rearranging its debt since its finances came under severe pressure last year as a $2 billion euro bond payment drew close. The IMF says Angola's high external debt service and oil dependence are weighing on the country's sustainable growth and underscores the urgency for structural reforms. The international lender says the country's economy recovered in 2024 and is expected to continue improving, but risks remain high, stressing the importance of a return to a fiscal consolidation path, including reforms of fuel subsidies. Bloomberg has learned that Spanish lender BBVA is in talks with Angola's government to provide a loan of as much as $1 billion. The loan would be for public investments in a range of sectors as the oil-producing African nation seeks to diversify its economy away from oil. South Africa's antitrust watchdog has penalised tech companies, including Alphabet's Google and Meta's Facebook, for anti-competitive practices that it says are hurting local media companies. The Competition Commission says Google's conduct hinders the ability of the news media to secure and monetize digital traffic. Google says it disagrees with the claim. Still to come, Woodside Energy's profit more than doubles. We'll hear from the CEO next on the LNG market, as well as geopolitical risks. That's up next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Paul Allen in Sydney. Woodside Energy's full-year profit more than doubled after the Australian LNG producer's output rose to a record. CEO Meg O'Neill discussed the impact of geopolitical risks on the business with Bloomberg's Heidi Strabwatz.
Some of the changes that are coming out of Washington, and what does that mean for the energy sector? So tariffs, sanctions, peace deals. It means it's a little bit difficult to predict. So the things that we focus on are the things we control. Continuing to get value out of our world-class assets, managing the costs that are in our operating business, ensuring that our marketing team is ready to take advantage of the volatility that presents itself, and ensure that we can continue to deliver value to our shareholders through the cycle.
When you take a look at some of those various uncertainties, and a lot of it is coming from the US, right, be it trade tariffs that might impact growth and demand from key markets to potentially the return of Russian energy supplies, right? What is the biggest kind of impactful piece when it comes to the forecast going forward, do you think?
Yeah, probably a couple of key focus areas. One is a question around Russian gas, which we watch very closely. Certainly the infrastructure that used to take Russian gas to Europe, not all of that infrastructure is available anymore. And the European appetite for more Russian gas, I think, is tempered versus where it was in 2021. We look at the rate of other LNG developments, competing projects. One of the things we're seeing is a lot of slowing. So whilst our Scarborough Energy project, for example, which is to develop LNG here in Australia, is on track, many other projects are experiencing delays. We look closely at OPEC. So oil price is also important, not just for our oil business, but also for our LNG business. And in that space, we look at things like what's OPEC doing around potentially putting supply back to market, but also what's happening with sanctions both on Russia and places like Iran. So a lot to keep track of in our world. And I do expect it will continue to be a volatile year.
I'm curious, have you seen an uptick in interest when it comes to the Chinese market, particularly after the tariffs were put into US shipments?
Yeah, so the Chinese market is interesting. We have a very long-dated Chinese contract from our Australian business, and the buyer there has been a very reliable buyer that we've known for many years now. For our Louisiana LNG project, our focus much more is on bringing in investors in the project than trying to place LNG, issue LNG contracts at this point in time. So whilst we do have quite a bit of interest in LNG contracts, our focus is on the sell-down parties. Look, I'm sure Chinese buyers will be in the mix. They have a preference for the very lean LNG that comes out of the US. But again, with the geopolitical tension, I suspect their appetite will be a little bit tempered in the near term.
Woodside Energy CEO Meg O'Neill speaking there to Bloomberg's Heidi Strabotz. Still to come, oil edging higher this morning as investors assess a fresh wave of US sanctions on Iranian crude. Details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Paul Allen. Well, we've got oil edging higher this morning as investors assess a fresh wave of US sanctions on Iranian crude, as well as more tariff threats. For the details, we're joined by Stephen Stapczynski, who leads our Asia Energy team. So, Stephen, we've got the US putting more curbs on a shadow Iranian tanker fleet. What more details do we know?
You know, it is the latest by the Trump administration on brokers, ships, and people related to that sector, particularly in shipping Iranian crude. It's smaller in scale than some of what we've seen in the past. Some 13 ships were hit, as well as 22 people. To put that into comparison, the Biden administration, right before President Biden left office, had set dozens of ships with new sanctions. So 13 is relatively small in the grand scheme of things. But it does show that the Trump administration is continuing to put this maximum pressure on Iran. So you're seeing an increase in oil prices from that today. I think the big question is, what does he do from here? Is he going to put more pressure on Iran? Because there's this interesting dichotomy, which has always existed with Trump and in the previous Trump administration, which is the president wants cheap oil for consumers because he wants the voters to see that gasoline prices are falling. But at the same time, he wants to look tough on countries like Iran. And the tougher you get on Iran, it risks less oil in the market and higher prices. So how is it going to strike that balance? As well, you also have the incoming tariffs on Canada and Mexico. The U.S. imports a bit of Canadian crude for refining, which turns into products. That as well could lead to higher gasoline prices.
Well, at the same time, we've now got more oil flowing into Iraq through Kurdistan, 185,000 barrels a day, thanks to a restored pipeline. But could we potentially see even more flowing in the future?
You know, I think the question is, what does OPEC Plus do, right? That's another thing that Trump has kind of put pressure on them in the past to do things that he wants them to do. And one thing that we're going to be watching closely is, does OPEC Plus add barrels to the market? There was an expectation that their planned increase later this year was going to go ahead, especially since the market was tightening after the Biden administration's sanctions on the dark fleet vessels had led to an increase in prices. But now that things are softer, especially as Chinese demand is still not where a lot of those in the trading community were hoping it would be, we're certainly in a spot where if you add those OPEC Plus barrels to the market, if you increase that output, then you're in a potential situation where prices do get softer to such a degree that Brent maybe falls below $70, something that Saudi Arabia maybe doesn't want.
All right, Stephen Stapczynski, who leads our Asia Energy team, thanks for joining us. Just got some breaking news out of Indonesia. Indonesia and Apple said to have agreed terms to lift Indonesia's ban on the iPhone 16. The Ministry for Industry says they're set to sign a memorandum of understanding with Apple that'll bring an end to that 5-month tug of war that forced the US tech giant to raise its promised investment in the country to $1 billion. So if you're in Indonesia, you'll soon be able to get your hands on an iPhone 16s. That's it for Horizons Middle East and Africa. I'm Paul Allen. Daybreak Europe up next. This is Bloomberg.